Well, as the Reserve Bank's Monetary Policy Committee prepares to make its second interest rate decision of the year this afternoon, it's widely expected that the committee will raise the repo rate. It's anticipated that the central bank will hike its lending rate by anything between 25 to 50 basis points. This as it tries to curb high inflation and has stubbornly remained above its target bracket. Let's bring in Chief Economist at Econometrix, Dr Azar Jammine. A very good morning to you, Dr Jammine. The general consensus is a hike of about 25 basis points, with others saying a bigger than expected hike is not inconceivable. What are your predictions?
My predictions are in line with the consensus. I think there is very little doubt that we will see a rate hike. And there's very little doubt that the rate hike will be not a particularly big one, limited to 0.25%. The main reasons why we're going to have a rate hike is because inflation surprised last week on the upside rather than the downside. Consensus forecast had been anticipating a further decline in inflation, continuing a trend that had been in place for 4 months, but instead the rate picked up from 6.9 to 7%. In particular, the rate of inflation excluding food and fuel rose quite sharply from 4.9 to 5.2%. That's the so-called core inflation rate. And the Reserve Bank examines this very closely because it gives you an idea of what the underlying trends in inflation are. And the increase there suggested that we are starting to see knock-on effects throughout the rest of the price system from what happened with food and fuel over the past year. The second reason why we're going to have a rate hike is because overseas central banks similarly all announced rate hikes last week. Especially we're talking about the US Federal Reserve Board, the Bank of England, the Swiss National Bank and the Bank of Norway. So, you know, we're virtually compelled to follow suit now. As to whether it'll be 0.5%, I don't see why. If the banks overseas are limiting their increases to 0.25%, we have a much weaker economy. Our inflation rate, our inflationary pressures are, whilst they are there, are, if anything, a little lighter than they are overseas. I mean, in Europe and the UK, inflation's over 10%, so at 7%, we're actually quite subdued. And so there's no need to go all the way and raise by 0.5% at present.
You talk about a weaker economy. There's those concerns about raising interest in an economy that currently shows no prospects of growth. Where will South Africans get this money to pay this concerns?
Some of them will get this money by borrowing. And what we have been seeing over the past year is a significant increase in borrowing by individuals to a greater extent than anything we've seen in the past decade. And that is helping them to survive under such circumstances. But over and above that, we're likely to see pressure on consumer spending not to grow.
So should a hike be announced, this would be the 9th consecutive hike since November 2021. How is this, going into the conversation of the rising cost of living in South Africa?
Of course, it's a big element in the rising cost of living. I think the only consolation one can put forward is that what would happen is the prime overdraft rate would go to 11%. And if you look at our historical trend of interest rates, well, it's been well over 11% for many decades. So 11% by historical standards is not all that high. And therefore, to that extent, is not going to weigh down as heavily on consumers as could have been the case if we started seeing 20 or 25% interest rates as we had in the 1980s and 1990s.
So whatever decision the central bank takes this afternoon, will it be, is this action in any way able to rein in the rising inflation?
Well, it does contribute indirectly to stemming inflationary pressures, even if it weakens the economy at the margin. That makes it businesses even more reticent to raise prices because they know they won't be able to sell their goods in the face of higher interest rates. So to that extent, it does have a smaller, it's a marginal effect, but it's part of a whole process that's been in place for over a year now. And I think the best that we can hope is that this might just turn out to be the final increase, but I'm not at all convinced that that will necessarily be the case.
I want to digress just a bit, just to wrap off our conversation. You were talking earlier about the global scenario, just in terms of the global conversation of changes in the banking system. Where does South Africa stand in this conversation?
South Africa has a very sound banking system. In part, it's a source of criticism because we have 6 huge banks that dominate the banking system, and they're all very well capitalized. The Reserve Bank is also extremely astute at maintaining monetary discipline and ensuring that banks have enough reserves to cover their liabilities. So I don't think there's all that much risk to our banking system. But overseas, there are fears that we could well see further problems in the banking system. They've quietened down in the last couple of days, but there is concern that that may not be the final straw. And it arises from the fact that short-term interest rates have risen so steeply that banks' borrowing costs are now escalating at a pace far in excess of the income that they can derive from investing in longer-term maturities. So they're, in many cases, losing money now. In South Africa, that isn't the case at all. Our long-term interest rates remain a lot higher than our short-term interest rates, and so banks are still managing to profit, even though they are now borrowing at higher rates than before. But they're still managing to invest at rates substantially higher than the rates at which they are borrowing.
Dr. Azar Jammine is an economist with Econometrix, talking to us in anticipation of those decisions of the Reserve Bank's Monetary Policy Committee this afternoon.